Thank you. Thank you very much for the kind introduction, and thank you for having me again back at the Oil and Gas Conference. As mentioned, my role is really to think about risks and uncertainties principally, and that's what I want to talk to you about today, really the challenges and the opportunities of this lower carbon future that we may see develop. Now, really there are 4 parts to this short presentation. I just want to touch on our thoughts around long-term energy demand as part of our base case, and then really spend a bit of time thinking about 4 key trends that we think could make the world look different to that base case. And by that I mean energy efficiency, the impact renewables is having and will continue to have, electric vehicles, and then finally the kind of resurgence or return of environmental legislation and policy, specifically around the Paris Climate Agreement. Alternative scenarios, we've got our base case, we've got a carbon-constrained world that we've been working on over the last year or so, and then the IEA 450 world I'll touch on as well. And then finally, how do producers respond to this potential future, some thoughts there. So this first chart shows you our projections for world primary energy demand over the next 20 years. It's on a fuel-by-fuel basis, and you can see that we do continue to see growth, and we continue to see hydrocarbons dominate demand over the next 20 years or so. From a regional perspective, that share in 2035 looks something like this. Again, hydrocarbons are a feature all over the world, but certainly in Asia Pacific, where we have China, India continuing to develop, and still a reliance quite heavily on coal in those markets. From a global perspective, the share looks something like this. So we think world energy demand could reach about 17,000 million tons of oil equivalent by 2035, and that would be roughly 80% hydrocarbons, and you can see that split there on the pie chart. So that's the base case, but as I mentioned, my job is really to think about risks and uncertainties, and these key trends which could shape the world to make it a little bit different are definitely worth watching. And the first one, as I mentioned, is around energy efficiency. So here we see a chart which is showing, the scatter chart shows GDP per capita along the bottom axis, and then energy intensity along the vertical axis in million tons of oil per dollar of GDP, or $1 billion of GDP. This is in 2000. You can see that the developed economies sit quite happily in this high income, low intensity quadrant, and emerging markets sit in a kind of high intensity, low income space. As we move to 2016, you can see how that growth, the size of the circles, is proportional to each one of these, to final energy demand in each one of these markets. Even if these economies have grown, their intensity has come down quite a lot, and that's happened at a relatively low level of GDP per capita. So you can start to see this signature of energy efficiency starting to come through already. In 2035, the picture will look something like this. You end with this kind of clustering down in this bottom quadrant, or towards the bottom quadrant. And while we continue to see GDP growth right across the world, that impact of efficiency, that lower intensity, will help to shave some of that potential demand off in the future. So we see demand growing, but maybe at a slightly slower rate. So the renewable side, I think, is also really interesting and quite critical, especially in this market. Now, what this chart is showing you is a time series of power purchase agreements of solar power projects in the United States over the last 10 years or so. Each one of these circles is an individual project, and the size of the circle is proportional to the size in megawatts. The vertical axis shows US dollars per megawatt hour, and it's quite clear what's happened over the last 10 years. The cost of solar power has collapsed in the last decade. Now, some of these newer projects in places like California are now competitive with thermal generation, even on a subsidy-free basis. And that's quite significant. It's making pretty big impacts on power markets over there. But it's not just a story about the US. In May, we had a world record project in Dubai, came in under $30 per megawatt hour. And in August, there was another world record in Chile this time, getting down to $29 a megawatt hour. Now, I submitted these slides a number of days ago, and on the way here yesterday, I found out that there's been another world record, and we're now down at $24 a megawatt hour, or somewhere in that margin. So costs are falling very, very fast, and we think that there's scope for them to fall further, and that range equivalency, where renewables are competitive with thermal generation will continue to expand. Another thing which has changed very dramatically over the last few years, and 2 years especially, is the story around electric vehicles. So we see on the chart here on the top left our projections for EV sales globally, again, part of our base case. We see about 10 million units per year in 2035, but that's in comparison to a global market of cars and light trucks, which is around 100 million. So about 10% of the market could be EVs. But having said that, I think there's scope for this to move up, and it could well be risked to the upside in future forecasts. And the reason for that, I think, is the impact of this car you see on the inset, the Tesla Model 3. This is a car which doesn't exist. It's not even due to be released, and yet they've taken 370,000 pre-orders for this car. And that's created quite a remarkable reaction in other automakers, and the rest of them are really scrambling to get a share of this market, which I think is proving that there's latent demand for a cost-competitive electric car. Now, 10 million EVs in 2035 equates to around 1 to 2 million barrels a day of lost oil demand. If we were to get up to 6, 7 million barrels a day of lost demand, that could be quite significant when we're thinking about future growth. And really, the key there is the battery costs. $100 per kilowatt hour is the key marker to watch for. At that point, if you can make a battery at that sort of price level, then you're looking at an electric vehicle which is price competitive with a regular kind of car. The other thing to think about is, what's the story around renewables? If you've got a battery solution which is great for electric vehicle, you've potentially also got one which is really good for renewables as well. And that means if you were to see energy storage become cheap enough, commercial, you could see a huge upside in renewables, even from what we think in our upside cases. The next trend is really around the Paris Agreement. Now, this is something that I think is extremely significant and shouldn't really be understated. It's the first multilateral emissions treaty to emerge from the UN Framework Convention on Climate Change since the Kyoto Protocol in 1997. Fundamentally, parties to the Paris text have agreed, and apologize in advance, this is a bit of a mouthful, but they've agreed to hold increases in global average temperatures to no more than 2 degrees centigrade above pre-industrial levels, and to pursue efforts to limit that increase to 1.5 degrees. Now, as I said, it's a bit wordy, but what it means is there's a global carbon budget, there's a global limit on temperature increases, and that applies forever. There's no time limit on that at all. To get to that, countries are bound to follow something called nationally determined contributions, or NDCs. Now, these are quite a disparate set of documents. Some of them are on emissions intensity, some are on absolute emissions. But add them all up, and you get an emissions profile which looks a lot like that navy blue line on the chart there. It's lower than our base case that you see in light blue, but it doesn't do one of the other aims. It doesn't reach a global peak of emissions as soon as possible, which is, again, some text in the Paris Agreement. What it really doesn't do, if you look at the red line, is it doesn't get anywhere close to that IEA 450 scenario. Now, the IEA 450 scenario is an emissions profile which is consistent with that 2-degree aim. So on the face of it, the Paris Agreement doesn't have enough tools in its toolbox to meet its own objectives, and that potentially is a problem. However, I call your attention to that line, which I've underlined here, become more stringent over time. Countries are supposed to go back to the negotiating table every 5 years and agree ever stricter emissions limits, ever stricter greenhouse gas controls. And ultimately, that navy blue line should look a lot more like that red line in the future, and that would imply a lower kind of carbon future than we see today. So is it worth worrying about? Will it ever come into force? I had a different answer to this question 2 weeks ago, and you'll see why in a moment. The map shows the 174 countries plus the EU who signed the Paris Agreement in April in New York. Now, signing it doesn't mean it's going to come into force. To do that, it needs to be ratified by at least 55 countries, representing at least 55% of global greenhouse gas emissions. Until about 2 weeks ago, that was only a small fraction of countries and a tiny fraction of emissions. But now, China and the US have both ratified this in advance of the G20 a couple of weeks ago. This is really, really a big step forward. Firstly, because these are the two biggest emitters in the world, and together they get somewhere like 40 to 45% up towards that threshold. So not that much further to go. But more significant, I think, is the fact that China and the US were historically the biggest opposers to things like Kyoto Protocol and all of the emissions limiting treaties that followed. So to have these countries on board first, I think indicates a new momentum around these sorts of issues and certainly provides a bit more of an incentive for other countries to get on board. We've seen Brazil ratify since, the UK has indicated that they will ratify soon, and we think there's a raft of other countries that will come on board in the near future. So if we are looking towards this low carbon future, how does Denmark fit into this? So this chart shows you power generation annually here in Denmark over the last 15 years or so. Thermal generation is in blue and wind is in grey. And actually 2015 was a record year. So Denmark is a world leader in delivering a share of its electricity from renewables. Energy intensity is also very low here, very much among the best in the world, and we think that will continue. So by 2035, we think Denmark will only have about 58% of its demand met by fossil fuels. Now that compares, as I mentioned, to the 80% we have in our base case, but we've also done an alternative scenario, thinking about if some of these trends that I've spoken about were to be accelerated, and we've called that the carbon constrained world. And in that, we see the share of fossil fuels smaller, still quite significant, around 74%, but much more renewables and a definite shift away from coal and towards natural gas. And that's quite important, definitely is quite a positive story for gas. So to put those two scenarios into context with each other and where we were have been over the last 20 years, we can look at this chart. The navy blue bars show you coal, oil, gas, and zero carbon demand growth from 95 through to 2015. Now, that was all positive. You know, China, India were developing. Over the next 20 years, as emerging markets begin to mature, we think that even under our base case, the growth of hydrocarbon fuels will begin to slow. Coal and oil certainly, and gas a little bit, but still remaining quite positive. Under the carbon constrained world, we see coal very negative, oil slightly negative, and quite a strong story for gas. Again, we see this switch away from coal and towards gas in power generation. The IEA 2-degree world, which I don't think is actually that feasible, sees a very negative story for coal and oil, a slightly positive story for gas, and a very strong story for zero carbon fuels. Now, I think what this slide, the takeaway from this slide is that the switch to a zero carbon world or a lower carbon growth world is not really a matter of if, but when, how, what magnitude, you know, what regions will this happen first. So if we are going to see this, then how does Denmark fit in as a producer? These two charts show you, they're taken from our upstream service at Wood Mackenzie, and they show you initial and remaining oil and gas reserves, oil on the left and gas on the right. And you can see Denmark's a mature province. Many of the larger fields have been largely depleted. But we do see other fields like Hejre that need yet to come on stream, and in fact have to come on stream, even though they're relatively costly, relatively difficult and challenging. We do think these fields have to come on in order to prolong Denmark's oil and gas production. Some reinvestment in some of the older fields as well. But what about outside? Oh, sorry, I was also going to mention on this one. This, I think, reflects both the challenge and the opportunity that we see here. So we've got a challenging demand outlook and also the challenge of operating in a mature environment. But we still see demand for oil and gas existing over the long term. And I think with the right investment, Denmark can definitely play a part in that market for as long as it exists. So what lessons can we maybe take from the larger oil and gas companies? This chart, and again, I'm not going to explain it all, really gives you a perspective on where the majors are in terms of their low carbon investments. And we think there are kind of three core strategies being undertaken. The first is reflected by Total, which we think is definitely and aggressively pursuing entry into the renewables business. Statoil is leveraging its upstream expertise in marine environments in order to get into offshore wind. And the third strategy, which is really around decarbonisation of your legacy production, is reflected by Shell, which we think we know is heavily invested in CCS, calling for a global carbon price in order to kind of allow it to continue to operate as an oil and gas producer, but to strip out the kind of the bad stuff, the carbon elements there. we're really not here to talk about diversification away from oil and gas. So what if you don't want to diversify? What if you are unable? What are the options there? Well, I think in a lower demand growth, lower carbon world, it's going to be quite clear that there's going to be a focus on costs. This chart on the left shows our break-even cost curve for 2020, and the grey line is all of the assets that we cover across the world, and I've highlighted the Danish fields there in red. Now, in a potentially lower carbon world, lower oil demand, or lower oil demand growth, we could see prices being relatively weak, and I don't know exactly what they'll be, but just to put in the Brent 52-week average there, you could see that if prices stay lower for longer, we will need to shift down into this lower cost part of the curve. But if you think back to what I mentioned about oil versus gas versus coal, being in gas versus oil, I think, could be potentially quite positive as well. So having a kind of a gassier future as a producer, I don't think is a disadvantage either. So really, to begin to sum up, this chart shows you the, again, primary energy demand over the last 20 years and the following 20 years, from 95 through to 2035. The solid lines are total energy demand over that period, and the dotted lines are hydrocarbon demand, so the share of hydrocarbon in that mix. Our base case is 80%, the carbon-constrained world is about 75%, and even in the IEA's 2-degree world, which is very aggressive in terms of moving away from fossil fuels, we see about 65% of world energy demand is still met by hydrocarbons, even in 2035. Now that means we've had people like Rex Tillerson from ExxonMobil saying things like, the world will continue to need fossil fuels whether we like it or not, and I think that's probably true. It's very difficult to argue with given a chart like this, you see. But on the other hand, we've got data and analysis coming out around the state of the climate telling us that 2015 was the world's hottest year, almost a degree above pre-industrial temperatures already. And I think what this really reflects, all of these things together, is that the world could be quite difficult for oil and gas producers in the future, but there is a market. There will be demand. Demand growth might be quite subdued, and we might be operating in an area where the effects of climate change become more and more manifest. And I think that really kind of comes to the strategic heart of what producers need to think about and how they go forward into this different future. So really, to conclude, emerging trends are reshaping energy markets. The last 2 years, I think, have been very disruptive, and I thought the points before about why we haven't seen oil demand recover is partly because of these new technologies. Partly it's a thing about economics, but we are seeing a world in which new technologies exist in a way that they didn't before, and that will continue to be disruptive. The return of carbon policies, I think, is also very significant. Fossil fuels will definitely persist in the energy mix. I think that's quite clear, but growth trends are uncertain, and this shift towards zero carbon or lower carbon is really a question of when and how, not if. New oil and gas production will definitely be needed as older fields, older assets start to reach the end of their productive life, but a lower growth future means a continued focus on costs. So oil and gas producers will need to adapt. I think, diversify, reduce costs, decarbonize legacy assets, focus on core businesses. All of these things, I think, will become part of the portfolio of responses that oil and gas producers will need to adopt as we potentially face a future which looks a little bit different from the one we've seen in the past. Thank you.